Let's talk ETFs, and in some sense the local news version of our show, as I was just joking with Matt Kaufman, head of ETFs at Calamos Investments, joining me here on set at SIBO. We were talking that the keen Chicago observer of architecture in that promo would notice the Calamos office over on the west side of Chicago in one of those shots.
And I got the Calamos building in the West Loop. It's nice to walk down the street to come here. You don't have to fly to New York. We're all right here.
That's what is great about Chicago Future Finance, is that I really do believe that, especially after being abroad the last couple of weeks. I was talking yesterday, I believe it even more now. But so much of what is kind of the nucleus of finance is here in Chicago.
For sure.
Your guys' growth in one of your funds, the autocallables, is over, it says on the screen 250, but it's now at like 280, which means you must have been pulling in money literally from the time I checked that a couple of weeks ago.
It's been tough to keep up with the flows. Obviously, we're thrilled with that adoption. The auto-callable space is a massive segment of the structured note market. If you're familiar with covered call funds, that's a $150 billion market in the ETF world. But you go to structured notes and auto calls dominate derivative income there. So we built the world's first ETF that brought that into the ETF world. Autocallables, it's a lot like a long-dated put writing strategy that has a call feature. It allows you to get a really high, stable income with getting your principal back, at the end of the outcome period or the end of that life. Okay. You can think of an auto call a lot like a bond that pays you monthly income and then returns your principal as long as the equity markets don't fall too far. So you're tied to equity markets instead of duration or credit. But that fund has taken off, $280 million in the door. The volume is going very strong. A lot of demand for that.
It is so thematic. This fund, yesterday, Innovator ETFs was here with the twist on the buffer concept.
Oh, sure. Dual directional, I think.
Exactly.
Right?
Yeah, very interesting. Almost like a way for someone to actually get rewarded if the market goes down.
That's
their highest payout when it's actually down. But so much of these are focused on either kind of hedging downside or having a guarantee.
Yeah.
But then I can't shake this irony that the market just keeps going up.
Right.
So where do you think the spirit of it is stemming from? Is it just preservation of capital?
I think so. Yeah. This doesn't need the market to continue to go up to work. This is, just for clarity, this is not a defined outcome fund. We're not delivering a certain result over an outcome period. We've laddered together 52 or more auto-callables. We've done that synthetically. We've partnered with JP Morgan, taken their pricing model, delivered that into an index that we've built with Mercube, and then we trade that index on swap with JP Morgan. So really strong collaboration with those two institutions, and we've delivered that into the market, a derivative income type strategy. But not a defined outcome fund, but certainly gives you really high, stable income there.
Where does the auto-callable market originate from? You mentioned the structured product category. Halo Investing here too, a big player in that.
Yeah.
So much of the Chicago, again, to kind of keep bringing it back home.
But
conceptually, and kind of makes sense. Mechanically, where does it start from, and what's the liquidity of those auto-callables, and is that market getting bigger? Who's servicing that?
Yeah, good question. The auto-call market takes about 50 to 60% of the volume of structured products in the United States. It's about similar around the world. It's a massive market globally, and people love the auto call for the ability to collect a coupon as long as the underlying index doesn't fall too far. So when you build an ETF, you want to build something that's on a really liquid underlying. So we've used an S&P 500 base that has a volatility target to it, and that really stabilizes the options pricing. So we're in the options pit here. We have stabilized parameters of that pricing model, so that we can deliver a really high, stable coupon every week that an auto call gets issued into the product.
Okay, so you're guaranteeing basically 100% par all the way down to a pretty deep sell-off level. What,
60% is a 60% principal barrier, or 40% minus performance barrier. That's correct. Yes.
And then 14%. If we actually take my screen, I'm pulling it up right now and make sure I get all the numbers right. The dash line here is when you add in the coupon, which gets you to what, 114?
That's right. Yeah, so you can think of those dashed lines as your monthly coupons. The dark blue line is your principal value. So as long as the reference index doesn't fall by 40%, you're going to get your coupon.
That's that par level payout all the way down to a big drop in the market.
Exactly. So then if the market is down by 40% at maturity, so these are 5-year auto calls, So that line's got to be down by 40% 5 years from now for you to start losing principal. So you can question like how often does that happen? The only time you would have knocked in on this strategy would have been during the global financial crisis.
Okay.
And you would have lost about 17% of principal. That's the risk you take on. But since then, you would have gotten every single coupon. You would have gotten all of your principal back at maturity or when you're called away. That's in the name, the auto call feature.
Got it. Okay. I feel like a lot of these funds, they're kind of they're providing a purpose, a service to functions that you could kind of do if you were very active in the market, basically.
Sure.
Or even if it's, like I think about people who are buying CDs and moving from one to the next, there's, it's a very different type of, I think, approach or purpose than some of the other kind of either defined outcome. I know you don't define it that way, but
for sure.
Buffer concepts as well. What I also want to bring up is the notion of kind of how the premium shifts, because anytime you're talking about options, we want to think about, okay, well, is this because of a volatility regime that you're kind of assuming is going to hold, or how much does that guaranteed premium sway based on what happens in the market?
Yeah, that is one of the beautiful things about CAIE is that vol premium, that income you collect, is largely stable. It's about 10 to 11% over risk-free rate every week. So you can see, we have a tool on our website where you can see we've laddered all of these auto calls together. That laddering concept's, not new. People ladder bonds, they ladder different types of strategies. We've laddered together auto calls. What we're seeing from advisors is that this is the easy button for them. They said, we usually shop for auto calls all the time. We get called away. We have to go buy a new one.
Right. That's kind of talking about the mechanical process,
exactly,
right? The actual physical. You're kind of doing that service, basically.
Yeah, so they called when we launched CAIE, and they said, we love this. You've solved a massive problem for me. One advisor in particular said, I fly to New York every quarter to meet with the banks, find the best notes. Said, I'm not flying to New York anymore. This solved that problem for me, which
That's
is great.
Interesting. That's a good sales pitch.
Yeah,
right?
exactly.
You gotta save up, but then you also don't accrue the miles as well. So
true. There's a trade-off.
To come back to this real quick, because I think this is kind of cool that you guys are putting this out basically data actively, right? So you can kind of see where the premium's at based on maturity.
That's right. So this is a dashboard, an auto call dashboard. Looking at your screen here, you can see that we've laddered together 52 or more auto calls.
Okay.
Each dot is an auto callable
contract. Okay.
You can see the term sheet for every one, and as you hover over, you can see that stable income, about 10 to 11% over risk-free.
Got it.
So you look at covered call strategies. When you sell that option, volatility is a big driver of the income you can collect. Whereas here, when you sell that put option, the premium income is largely stable because we've stabilized the volatility.
Very interesting. I love that you can actually hover over and see kind of, it helps you understand what's happening here.
For sure.
When you think about it as kind of the weighted average. There it is, the weighted average coupon, bottom left. Bingo. That's how I know I'm following along.
There you go.
Because, you see some of these up here that are really juicy, right? Like there's one here at Fort. So that's cool. I like it.
Yeah.
I asked our AI, who is kind of interested in this type of fund. You kind of already hinted at this, but I said, what kind of investor? I want to hear your reaction. It's less about conservative investors and more about those who want predictability with the trade-off. Buyers and trying to beat the market. They're outsourcing timing to the product itself. Is that kind of what we just talked about?
We're diversifying timing risk. Yeah, exactly. Okay. Yeah, we keep reading here if you want. But
the high net worth investors who want the smoother coupons and sideways markets. Advisors managing clients who fear the drawdowns. That part I think we know is part of the sales pitch. And yield seekers in low vol regimes. That kind of comes back to what you mentioned earlier. Is it it's different than a bond proxy, but like it kind of can't be thought about that way.
Yeah, you're going to get that high stable income level. There are risks. The risk you're taking on is a severe sustained market drawdown like 2008 as we described. But people who are seeking income, they're using this inside their portfolios. The volatility is going to look a lot like the S&P 500 over time. So you have to be comfortable with equity-like market volatility, and you can exchange that for a really high, stable coupon. So the last piece that we didn't mention is taxes. The coupons are remarkably tax efficient. About 90 to 95% is going to be treated as return of capital. So that's just going to reduce your cost basis. You'll pay long-term capital gains if you've held for longer than a year.
Okay. As the fund gets bigger and bigger, are you going to be able to find all the auto-callables you need?
We don't have to find any. So this is all synthetic. It's swap-based.
So you're swapping it. You can just keep building it out.
Exactly. Yeah, we can scale this into billions of dollars with no issue.
Got it. Okay. Fascinating stuff. A big
Thank you.
success story for a big fund, $250 million plus, right? As you said,
Still
now
going.
Florida 280. CAIE is the ticker.